Welcome everyone to our webinar on selling a business, how to successfully complete your business sale. We would first like to start with an acknowledgement of country. We acknowledge and pay respect to the past, present, and emerging traditional custodians and elders of this nation, in particular the Gadigal people of the Eora Nation, whose land our Sydney headquarters are situated on, and the various lands on which those of you are joining us. My name is Bianca Reynolds, and I am a practice leader in LegalVision's corporate team. I'm joined today by my colleague, Sarah Condie, who is also a lawyer in our corporate team. Before we begin, a couple of quick housekeeping items. You'll be emailed the webinar recording with the slides. Please submit your questions in the chat box and complete the survey after the webinar. All attendees are also eligible to receive a free consultation with us to discuss how we can help you with your contracts or any of your legal needs. To request your free consultation, please provide us with your contact details in the survey that appears at the end of the webinar. So today we will be discussing preparing your business for sale, structuring the transaction, negotiating and documenting the transaction, and managing the completion process. At the end of the webinar, we'll also be answering some of your questions. So please submit your questions in the chat box throughout the webinar using the chat function, and we'll answer them at the end for you. And now I will begin by speaking about preparing your business for sale. So when you're planning to sell your business, you need to think about whether or not it is the right time to sell. So some factors that can influence your decision are market conditions and trends for your industry, the economy as a whole, and of course the financial performance of your business, particularly over the last 2 to 3 years, and its projections for the future. Once you've decided that it is the right time to sell, you then need to figure out a realistic asking price. So the price you can get for your business will depend on if its financial performance has been improving and growing, maintaining at a steady pace, or declining. So if you can sell your business towards the end of a growth period, this will of course help you achieve a higher price. On the other hand, if your business is in financial decline with high debt and liabilities, then it can be more difficult to get a higher price. There are many components that go into making up a business, such as goodwill, assets, and liabilities. So we recommend that you obtain advice from an accountant, a valuer, or even a business broker to assist you in correctly valuing your business so that you can achieve the best possible asking price. So the next step is then to identify potential buyers. Engaging a business broker could assist you to more easily connect with potential buyers. You should find one that has experience in your industry and can tap into their network of industry connections. You can otherwise advertise your business for sale online, such as via platforms like Seek Business, and you may even have industry contacts that you can reach out to see if there is interest from the market directly. For example, competitors or even employees could be potential buyers of your business. So once you've figured out that it's time to sell and you've figured out a suitable price, it's then time to start getting your business in order so that you're ready for the due diligence process. The first step is to know the strengths and weaknesses of your business and address them early on. You should do an audit of the documentation of your business to understand where there are any gaps that need to be addressed. For example, you should make sure that your financial statements are up to date and key legal documents are in order. In particular, you should have signed and compliant employment contracts in place for your employees and also written customer and supplier contracts, particularly with your material customers. If you generally only have handshake agreements in place, then this could devalue your business as there may be limited value that can be transferred to an incoming buyer. It's also important to start thinking about other key components of your business and whether you have everything in place. For example, do you have a registered business name? Do you have a trademark that protects your business name? Is your equipment and other physical assets in good working order for their age? If you operate from a physical premises, do you have a lease in place, and does it have a sufficient term remaining on it? These are all questions that you should start asking yourself before you take the next step and proceed with a transaction. Once you've prepared your business for sale and you've got a buyer in mind, the next step in the transaction process is for you and the buyer to enter into a non-disclosure agreement. This is also called a confidentiality agreement, and it can help to keep your business information confidential as you start entering into discussions with the buyer. And this will usually kick off the due diligence process. So due diligence can occur before or after a heads of agreement or a sale agreement is signed. However, in either case, there's usually a process by which the buyer will want to investigate your business to understand if it's worth the asking price and whether there are any liabilities or risks that they need to be aware of in proceeding with the purchase. So in order to start that process, the buyer will first request information from you and will send you a list of records and documents that they want to inspect, such as, financial statements and material contracts that you have. You'll then respond and send them that information via email, or it could be via a data room, which is essentially like a Dropbox or Google Drive platform where you can upload and access documents. It may also have functionality for questions to be asked using the platform too. So the buyer and their due diligence team, such as their lawyer and accountant, will review the information you provide and will then ask you questions about that information. This is called a request for information or RFI process, and the questions can be submitted online via that data room that I mentioned, or via email, or even via a Word document or a spreadsheet. You'll then submit your responses to those questions, and you can obtain advice from your lawyer and accountant about how best to respond to those questions. The buyer's legal and accounting teams will then generally prepare due diligence reports to provide the buyer with advice about their review of the documents you've provided about your business. The buyer will then consider the information provided, the reports, and they'll make an assessment about whether or not they intend to proceed with the purchase of your business, or if they might want to try and renegotiate the purchase price, or they might want to request specific warranties and indemnities in the sale agreement to help limit any risks they've identified in proceeding with the transaction. So I'll now hand over to Sarah, who will discuss how to structure your transaction.
Thanks, Bianca. As we've already foreshadowed, it's important to obtain the right legal, tax, and financial advice, not just when preparing for the sale of your business, but also when determining how best to structure the transaction. We recommend seeking advice from these advisors as early as possible, as this will help set you up for success. We recommend getting this advice even before finalising any term sheet, which we will discuss later in this presentation. So when thinking about structuring the transaction, there are two main ways you can go about conducting a sale of your business. You can either sell the shares in the company or sell the assets which comprise your business. There are pros and cons to each of these approaches, which I will discuss from your perspective as the prospective seller. So in terms of a share sale, there are several advantages to conducting the sale of your business in this way. In this type of transaction, the buyer is going to be acquiring the whole company. So that means all the client, supplier, and employment contracts are going to stay with the company. Therefore, there is less effort and risk associated with obtaining any consents and ensuring that clients and suppliers and employees stay with the company. This structure may also have tax advantages when compared to an asset sale, and this will be something that's very important to discuss with your tax advisor or accountant. On the other hand, a share sale does have some disadvantages or risks to you as the seller. For example, if the buyer is acquiring the whole company, they will inherit all historical, actual, and contingent liabilities. So, to protect against these liabilities, you as the seller may be required to provide extensive warranties, which may exist for an extended period of time. Depending on who the shareholders are, this liability may even extend to you personally, and you may need to provide a bank guarantee as security in case of a breach of any of the warranties. Also, with a share sale, you should be aware that there will likely be a more involved and ongoing due diligence process. Moving on to an asset sale, there are also various pros to consider when looking at selling your business this way. For example, given the buyer will be acquiring the assets of the business rather than the company as a whole, you will be required to provide fewer warranties and indemnities when compared to a share sale, speaking generally. Also, you could agree with the buyer to exclude any assets that are not intended to be transferred. On the other hand, there are some cons with an asset sale. For example, the transfer of each of the contracts and assets being purchased by the buyer may require the consent of third parties, which can be time-consuming and onerous on your part as the seller. You will also need to procure releases of any existing security interests which affect the sale assets. In an asset sale, as compared to a share sale, the liabilities will generally remain with you as the seller, so because you remain the owner of the company. So if you do wish to wind up the company after the sale, costs may be associated with that process. So as you can see, there are advantages and disadvantages to both asset sales and share sales. However, rest assured there are ways to mitigate the risks associated with both types of transaction. As such, I reiterate that it will be important to seek advice on the risks from a commercial, financial, and legal perspective to select the most suitable transaction type for your circumstances. Once you have decided how to structure the transaction, it will then be important to consider how the buyer is going to pay you the purchase price. There are a number of ways to do this, and I'm going to discuss some of the common payment structures with you in a moment. However, first I'll just note that the transaction document will usually be the document that sets out the purchase price and the way in which it will be paid. And you can structure a transaction using a combination of the payment methods you see on the screen, and which are the payment methods that we see most frequently. So there's upfront payments, deferred payments, earnouts, vendor finance, and deposits. If part of the purchase price is to be paid up front, this means that the part of the total purchase price will be payable by the buyer on completion of the transaction. We're going to talk about the completion process in a bit more detail later in this seminar, but completion is the point that the assets or the shares change ownership from the seller to the buyer. If part of the purchase price is to be paid as a deferred payment, this means that a portion of the total purchase price will be payable on a date after the completion date. The obligation on the buyer to pay this deferred payment will often be conditional on certain conditions being met. For example, the achievement of certain performance milestones of the business by a certain date, or alternatively, it will just be payable on a later date, which would be nominated in the transaction document. Another way to structure part of the purchase price is to use an earn-out mechanism. In general terms, an earn-out refers to a certain pricing structure where a portion of the purchase price is earned by the seller based on the performance of the business after the acquisition. So typically, the transaction document will set out certain performance milestones that may also be contingent on certain timeframes. If and when these milestones are reached, the purchaser will pay the relevant portion of the purchase price to you as the seller. Earn-out payments can be for cash, but they're also commonly for equity in the buyer's company or its related entity. The purchase price could also be payable by way of vendor finance, and this happens when you as the seller also funds part of the purchase price. In this circumstance, the buyer would usually pay a portion of the purchase price upfront, as we've already discussed, and then meet the balance, including interest of the purchase price over an agreed period of time, with regular repayments to you as the seller, much like paying back a loan. There are various considerations to be addressed before entering into a business sale, and we recommend seeking legal advice to confirm whether or not this would be an appropriate option for your circumstances. And finally, it's worth mentioning here that with all of the payment methods I've discussed, it's possible to provide for the payment of a deposit by the buyer, and this would usually occur on signing of the relevant transaction document and would typically be subtracted off any upfront payment of the purchase price. One thing I'd like to mention before we move on is the concept of financial assistance. So I just wanted to remind you that it's important to keep in mind if you as the seller are assisting the buyer to purchase the shares in your business, in your company in any way, there might be requirements in the Corporations Act that you need to comply with. So in this case, it's going to be very important to seek legal advice. So now I'm going to hand back to Bianca, and she's going to discuss how to negotiate and document the transaction.
Great, thanks, Sarah. So I'll now talk through some of those tips for negotiating and documenting the transaction once you've worked out a suitable structure. So first, it's important to understand the buyer's motivations and concerns. It can help to think about the strengths and weaknesses of your business and what might be deal breakers for the buyer. As discussed earlier, a lot of the buyer's concerns will be driven by the outcome of their due diligence. And so you need to understand where the material risks in your business lie. So for example, is it not having written contracts with material customers in place? Have you been in dispute with any customers or suppliers in the past? Are there any tax liabilities in your company, particularly in the case of a share sale? So if you follow our recommendations earlier about how to prepare your business for sale, then it may be that you can address some of these risks before you even begin negotiations with the buyer. You should also think about the buyer's motivations for wanting to acquire your business. It could be for wanting to expand their customer base by increasing sales in a particular territory, or potentially to acquire a specific customer relationship. Once you have a better idea of the reasons the buyer has for wanting to acquire your business, you can then focus on ways of providing comfort to the buyer to get at the heart of those key factors. This could include providing specific warranties or maybe even indemnities that you're comfortable to provide, but that you know will be of material importance to the buyer. So when it comes time to negotiating the transaction, there are some factors to think about throughout the process. The first is the bargaining power between you and the buyer, as this can be a significant factor in determining the terms of the transaction documents. For example, if your business is being acquired by a larger enterprise or an ASX listed company, then you might have less ability to negotiate certain terms. Another factor is the timing of the sale. So if you are desperate to sell because you're moving or retiring or starting another venture and the clock is ticking, then this will impact on your negotiating tactics, and you may want to focus on material issues to get the deal over the line quicker. On the other hand, if you don't have that kind of time pressure, then you may have the ability to spend more time negotiating and achieving more favorable terms. The final point here is to think about your risk tolerance and the buyer's risk tolerance. So you need to think about the material issues and key risk factors and address those as much as possible while giving the buyer wins on matters that are less important to you. Focusing on your deal breakers and what is most important to you, rather than trying to win every possible point, will help you get the transaction documents over the line quicker and the deal done sooner. So now I'll talk through some of the key transaction documents that you'll encounter throughout the process. As I mentioned earlier, a non-disclosure agreement is important to enter into with the buyer early on in the process, and certainly before due diligence gets underway. The second document listed here is a heads of agreement. Could also be called a term sheet, a letter of intent, or a non-binding indicative offer, among other terms. But essentially, the purpose of this document is so that you and the buyer can agree on the key commercial terms of the transaction upfront, so that no one wastes any time or money in trying to get through a deal that has major commercial issues. So we've dealt with a lot of transactions that have moved too quickly beyond this step and straight into due diligence and the legally binding transaction documents, while the purchase price and even the structure haven't been agreed yet. And as you can imagine, this can create a number of issues and draw out the process even longer as the parties are trying to agree on the commercial side of things while at the same time negotiating the legal documents. So the final document I'd like to talk about is the sale agreement. So this will generally be either a share sale agreement or a business sale agreement, depending on the structure of your transaction. So a lawyer with experience in transactions will be able to prepare a suitable document for you that protects your interests and includes key clauses such as conditions precedent, completion obligations, warranties and indemnities, and any post-completion obligations. They'll also ensure that the agreement sets out the particulars of your sale and is tailored and drafted correctly for your circumstances. Sarah is now going to take us through the completion process and what to expect on the day of completion.
Great, thank you. So once you've done all the hard work of negotiating and signing the sale document, it will be time to turn your mind to completion. Now, it's important to remember that the terms completion and settlement are actually referring to the same thing, and completion or settlement is the point that assets or shares change ownership from the seller to the purchaser. That will usually, but not always, be after the date that you sign the sale document. The sale document will typically set a target date for completion, and it will also nominate the latest date that completion can occur before the agreement terminates. Usually, completion will occur on the later of the target completion date and the date after all of the conditions precedent have been completed to the satisfaction of the buyer. So turning our mind to conditions precedent are conditions that will be set out in the sale document that must be satisfied before completion can occur. Depending on the transaction structure and the type of transaction you've chosen, this could include things like the buyer completing due diligence to their satisfaction, the seller obtaining any consents from third parties, for example, to transfer a contract or consent to a change in control of the company, the buyer obtaining satisfactory financing for the purchase, you as the seller securing release of security interests over any assets sitting with the business, and the employees of the business being sold entering into employment agreements with the buyer. The target completion date in our experience is often missed because conditions precedent can fail to be checked off in time. So when preparing for the sale of your business, make sure you plan for delays and don't assume that completion will occur on the target date. We've had experiences where we've had clients book holidays for the day after the target completion date, and that makes it really challenging to actually reach completion if there are any delays. So moving on, in the lead up to completion, you'll need to put your project management hat on, and regular communications with the buyer will be necessary. There are only a limited number of things that will prevent completion from occurring once you've signed the sale document. So it will be time to tell your employees, any key clients, and any other stakeholders. And you'll need to manage your business relationships with those and the goodwill sitting with the business to ensure a smooth sale process. It's also going to be the time to enter into discussions with your employees about what the business sale means for them, and that will be different depending on the structure of the transaction. You'll also need to start reaching out to any customers or suppliers or landlords to seek consent if required to the transaction. When you finally reach the completion process, it's important to remember that conditions precedent are for the benefit of the buyer. And this means that it will be the buyer's lawyers, usually, who will run the completion process. Typically, they will prepare what we call a completion checklist, which is going to detail all of the deliverables in the transaction document that need to be checked off before completion can occur. As soon as that sale document is signed, it's going to be your job as the seller to work with your advisors to address each of the conditions precedent to ensure that they're going to be satisfied as soon as possible. If you are worried that there are going to be delays or that you'll be unable to satisfy any of those conditions, it's important to flag this with your advisors and the buyer as soon as possible so a solution can be agreed between the parties. Often conditions precedent can be waived by the buyer, so there's often solutions that can be reached if you're worried that you're not going to be able to satisfy one of those conditions. As completion gets closer, the parties will usually have daily check-in calls with their advisors and frequent calls between both the seller and the buyer to make sure everything is in order. When we reach the day of completion, most of the work is already done. If there are any ancillary documents to be provided, for example, signed employment agreements, these are going to be provided to the buyer on the day of completion, but usually most of the conditions precedent would have already been checked off prior. On that day of completion, there will typically be a completion call between all of the parties to the sale to run through the completion checklist and just make sure that everything is complete to the satisfaction of both of the parties. Once everyone has confirmed that they're ready to complete, the buyer will transfer any upfront payment to the seller, and any remaining documents or items such as keys to rental properties or passwords to emails or social media accounts will be transferred. So that concludes the main part of our webinar. You might find our publication on how to sell your business useful if you'd like more information about this process. I'd like to flag that we also have an upcoming event that might be of interest to you on managing safety for remote workers, which is taking place on Thursday, the 15th of June at 11 a.m. Sydney time. Now we're going to answer your questions about our presentation shortly, so please submit them in the chat box if you haven't already. While you submit those, I'm just going to take a minute to tell you about our membership. So LegalVision membership is a cost-effective alternative, and it will allow you to have all of your business as usual legal needs covered for a fixed monthly fee. So you'll not only receive cost certainty, but also all-inclusive benefits such as unlimited document review, which includes reviewing your commercial contracts, unlimited consultations, which means you can book as many meetings with us as you need to discuss your commercial contracts or for any of your other business as usual legal needs. We have lawyers who specialise in franchising, corporate, employment law, and more, depending on what your business needs are. Your membership also offers unlimited trademark registration, all for a reasonable monthly fee, with options to purchase extra credit towards business sales, which are charged on an hourly rates basis. So now I'm going to hand back over to Bianca to answer some of your questions.
Wonderful. Thanks, Sarah. And thank you everyone for submitting through some questions. I'm just going through those now. So the first question coming through is fairly specific to this person's particular circumstances, but I'll just talk to it generally. So the question is around how can you sell a business if the business is operating as a trading trust and it has a particular government license or registration. So if you're operating your business as a trading trust, which is ordinarily through a discretionary or family trust structure, then you need to structure your transaction as a business sale as opposed to a share sale. And in terms of that government license or registration, it will be a question of whether that registration can be transferred to the buyer's entity or whether the buyer will need to apply for a new one. So if you are in that situation, then it's recommended to have a chat to the relevant government authority to understand if a transfer is possible or if the buyer would need a new application and registration, depending on the industry and your type of business. Okay, we've got a couple more coming through about if you are looking to speak to more than one buyer, particularly after you've received a deposit and the trial period has finished, but settlement has not yet happened. So ultimately, this will depend on if you, as the seller, have already entered into a legally binding contract of sale with the buyer. If that's the case, then generally you are legally bound to sell the business to that buyer, unless there are certain conditions in that sale agreement that are unable to be satisfied, and both you and the buyer, terminate the contract as a result. But really, once the legally binding contract is signed, it's not that you are able to then just go and try and sell it to other buyers who may offer you a suitable, a higher price, for example. So you do need to be quite careful about signing a contract of sale, making sure that it's suitable for you and the best deal for you that you can get at that time. Another question here is around some examples of milestones for deferred and earn out payments. So this really does depend on the nature of your business, but it could include things like certain revenue targets. If your company achieves, for example, $1 million in revenue, then you might receive a certain payment at that point. Otherwise, there could be quite more specific milestones in terms of if there's, a key customer contract that needs to be signed, or a certain percentage of employees that the company needs to retain, or a certain percentage of clients. So it can be structured a number of ways. So definitely, if that is something that you are considering, it can be very helpful to have a chat to a lawyer or an accountant to kind of help you work through some options for you in that situation. Another question here is, if you do a business sale, what happens to your company afterwards? So I might hand over to Sarah to run us through her answer to this question.
Thank you. Yeah, so if you're doing a business sale, and that's an asset sale when structuring the transaction, as I was speaking about before, you'll obviously be left with a shell company that doesn't have any assets or many assets in it, but there will still be shares on issue in that company, and you will still be the owner of that company. So obviously, you'll need to decide what to do with the company, and there are a few different ways that you can deal with that. Once you get the proceeds from the business sale, if there are any liabilities still existing in the business, you could use those sale proceeds to pay off any of those liabilities. And then if you didn't have any use for the company anymore, any leftover profits or assets in the business would be distributed to their shareholders, and you could wind the company up. There would be certain approval processes that you need to follow set out in either the constituent documents of your company or in the Corporations Act. So in that case, again, we would strongly recommend getting legal advice as to how to best approach that. Alternatively, depending on who the shareholders in the business are, you could keep the company and use it for something else. So if you were going to set out on a new business venture, you could absolutely satisfy any existing liabilities and then move on to set up your new venture using that same company. So again, we'd recommend that you get some legal advice on the various options, but there'd certainly be no obligation to let the company continue in existence indefinitely. I think we've also got another. Yeah, go ahead, Bianca. I think we've got a couple more questions there to answer.
Yeah, perfect. So another question coming through is, what kind of approvals do you need internally to sell the business? So Sarah, I don't know if you want to have a go at answering that one as well for us.
Yeah, absolutely. So the approvals that you'll need will generally be set out in the constituent documents of your company, as I just mentioned. So Most companies will have a constitution, not always, and other companies will also have a shareholders agreement. And then there are also requirements in the Corporations Act, that may be relevant depending on what type of sale you're looking at going through. So I think something important to remember is that if you are doing a share sale, it will actually be the shareholders who are entering into the agreement to sell the business, as they are the owners of the company. So there will be approvals that you need to get from those shareholders, and it will depend on any provisions that you have in a constitution or shareholders agreement as to what level of consent you need and whether you can oblige any of those shareholders to sell. So we would recommend getting legal advice in terms of reviewing those documents to see what the relevant requirements are. Usually we recommend, no matter what type of sale you're going through with, that you do try and document the decision-making process, even if it's not strictly required by the constitution or shareholders agreement. So you could pass board resolutions that document the decision-making process and include any minutes of any board meetings that you have discussing the merits of a particular sale.
Perfect. Thanks, Sarah. So I think we've got time for potentially one more question. So I think this question relates to an earlier question that came through, but I'll just read this one out. So can a seller present to the landlord more than one buyer at the same time, even though they're in a contract for sale with one buyer and have finished the exchange of contracts and trial period? So yeah, this does relate to what I was explaining earlier, that if you have entered into a legally binding contract with one buyer, then you're bound to sell the business to that buyer unless there are certain conditions precedent, as Sarah was talking about earlier, that can't be satisfied. So it would be quite unusual to try and present multiple buyers to the landlord. And certainly that would potentially be in breach of your contract of sale with the buyer you have entered into a legally binding document with. So definitely if you have exchanged contracts, then the expectation is that you need to get consent from the landlord to transfer your lease to the buyer that you've signed the contract with. Okay, and then in terms of one last question is around stamp duty payable on the sale. So this does depend on what state you are in, and it's certainly more of a tax-related question. So if you do have a specific questions around that we haven't had time to answer today, then please feel free to book in your complimentary consultation, and certainly we can discuss your specific circumstances in more detail and assist you at that point in time. So that's all we have time for today. After the webinar ends, a survey will pop up, and we would really appreciate if you could complete that survey for us. And please include your details so that you can receive that free legal consultation so that we can discuss your specific questions around how to sell your business. So thank you so much for joining us today. We really appreciate your time, and we hope to see you again soon.